Good morning, afternoon, evening, everyone. Welcome to the Do More of Your Money podcast. Great to be back here again with fellow colleagues. Episode 192, Chris. Can't believe we've got that far. I think we've done at least more than two together.
I think we've done a lot more than two together.
But yeah, great to have you here today. And I think we've got a great topic and some great individuals, just some discussion points to talk around. Topic today around market movements and your investments, and just really focusing around why investments are a long-term vehicle for clients' money, and actually talk a bit about the volatility and what we've seen over the last few months. I think that is actually important from our perspective in terms of transparency with clients. But Jeff, can I just come to you first, please, and just give us, rather than just go what's happened now, but actually just what's happened over the last few years in terms of market movements?
I think the last couple of years have certainly been typified by things that we haven't seen over the last 10 years, for example. And what do I mean by that? If we think about the change in the inflation backdrop post-COVID, something that we've spent a lot of time talking about and all of our listeners are very familiar with, but certainly inflation and that rise and significant rise of inflation is something that markets have been challenged by. Why have they been challenged by it? Because central banks have reacted. Central banks have reacted by putting up interest rates, and those interest rates effectively have raised the cost of capital across all asset markets. And that's had very significant effects when we look at equity markets, but also more materially when we look at what's happened in sovereign bond markets over that period of time. So if we think about sovereign bonds and we think maybe just let's look at the UK market. So sovereign bond issued by the UK government, 10-year gilt, for example. If we look from where that peaked in terms of the yield, and if we think about yield moves inversely to price, so as the yield goes up, the price of a bond comes down. If we look at that 10-year gilt over from peak to trough, we've went from 0.1% to 4.5% in terms of the yield in that gilt. Now, what does that mean then in terms of price? That means that the price has fallen some 35% over that period of time. And this is crucially important because bond markets, they're larger than equity markets. They are that market which sets the cost of capital for global assets. And it's really that change in the bond market that has impacted assets across the piece and impacted portfolios. That's been the key major dynamic over the last 2 years, one would argue. I think when we then start to think about that in the more short term, what's happened more recently in terms of asset markets, it's been really a continuation of that theme. Very much driven by, one would contend, three factors: the middle of the summer, July, August, which just increased further volatility into bond markets in particular. And bond market volatility, when we think about where it is today, we can look at something called the MOVE index. It lets us get a sense of volatility in the US Treasury market. Today, it's at comparable levels to it was in the global financial crisis. So that gives you a sense of how elevated volatility is, but global financial crisis, it was front and centre of the news. Doesn't make a great news headline to have in the 6 o'clock news we're talking about the bond market, except when we saw that significant period of stress with the Truss quartile budget. That was probably the last time we've really seen major media talk about the challenges in the bond market. But that's really the crux of the issue, Jamie. What's happened in the bond market over that period of time?
And from an investor perspective, how has that helped? How has that affected our portfolios from an investment point of view? Because I know that's obviously bonds are a consideration when you're looking at investing clients' money.
Yeah. And certainly that's been one of the key challenges for us. So if we look at that 2-year period and you think about global equities over the last 2 years, if we think about that in local currency terms, probably down around 7 or 8%. But if you think about that in global sovereign bonds, you're down around probably 20 to 23%. So really it's that which has happened in the bond element of the portfolios has been the real challenge, and that's where risk has manifested itself, and that is seen across all of the portfolios. The lower risk portfolios typically have a higher exposure to bonds. Now then, the other point that I think is really important to bring out is that bond market sensitivity does change when one thinks about the duration of a bond. So whether it's 2-year bond, 5, 10, 30-year bond, the longer the duration, the more sensitive it is to interest rate movements, changes in inflation. If you remember, we talked about the 10-year gilt and we said the price there was down around 30, 35% over that period. If we look at the 30-year gilt for another comparison, peak to trough, the price there is down around 53%. So different durations have different impacts on the value of the bond. And that just comes through in different ways within the portfolios. If we take our balanced portfolio, for example, duration there is around 7 years. So relatively short duration, but just thinking about any form of duration in that period of significantly rising interest rates is problematic from a bond's price perspective.
And Chris, I'll come across to you because, in terms of looking at the markets over, I suppose, a 20-year period in volatility, if we're looking at this period of time with the bond markets, is this something we've seen before, or,
Just thinking back, certainly over the last 20 years, it's not really something that we've seen before. So you've not seen interest rates rise that quickly, certainly over that 20-year period. I think, if we look back at sort of returns over that 20-year period, so that I definitely define that as long term. Yeah. And what I did here is I took an index, so it's 60% global equities, 40% bonds. Now I've done that because it's seen as a kind of proxy for a balanced portfolio. So over 20 years, you would have stayed invested, you would have received a return over the last 20 years of around 311%. So again, that illustrates the kind of returns that you can get. Obviously, over that long term, it's a specific period, but it is over that 20-year period. Now, within that, what was that characterised by? A couple of things. So obviously, we saw the GFC, the Great Financial Crisis, 2008. It was certainly, for me, the most challenging year in my career by a long way. As well as that, you've also seen quite an era of low interest rates as well. You've seen things such as quantitative easing come through as well. So again, that's been quite helpful for certain asset classes. Seen US equity dominance as well come through in that 20-year period. Think of some of those kind of big growth stocks like Meta, Facebook, whatever you want to call it. The incredible price rises that you've seen through some of them as well. So a real kind of mixed period is what I'm trying to say over the 20 years. Like some really sort of favourable conditions when you look back. But then what I would argue has certainly been probably one of the most toughest periods in the whole of history in respect of financial institutions, which is 2008.
Thank you.
Jimmy, the other thing to think about that in that historical context is the magnitude and the quantum of that interest rate increase. So if you think about, we've went from effectively 0.1 in the UK to 5.25. If you look back into the 70s, and the late 70s, early 80s, in terms of the interest rate changes that were coming through there, they were coming through from higher levels. But the magnitude of the interest rate change that we've seen today takes us back comparable to that time when we were last having to deal with significant inflation in global economies, which was the late 70s into the early 80s. So for a historical comparison, that's probably the two periods in which you can think about something similar in terms of the quantum of the interest increase that you've seen.
And I think as end clients, and we'll have this all the time, in terms of like what does the rise of interest rates mean to individuals? It's typically their mortgages and their mortgage payments, etc. What do we think, in terms of the Bank of England? We've obviously, there's considerations whether it's going to stay flat over a period of time, and if we come to the end of that. I think we've always said we've been in a very low interest rate environment, and what would you expect the aim to be for the Bank of England to get that interest rate to?
So if we look, it's a pertinent question given what we've just heard from the bank today.
Yeah.
And again, no change from their policy. Interestingly, when we look back to the last meeting, it was effectively split with Andrew Bailey having the casting vote to keep things unchanged last meeting. This time there was more of it. There was a majority actually voting for no change.
Interesting.
So I think that's quite telling in and of itself as to potentially we're getting closer to that peak of interest rate expectations. But also I think the other thing that we can't dismiss is the fact that rates may stay slightly higher for longer.
Yeah.
And that, whilst if you look at the statement with the bank's release today, rates aren't expected to go as high in terms of their forecasts either. Yeah. And certainly that's what's been reflected into the market today. And the same thing probably holds for Europe to an extent. US is maybe slightly different because of, whilst we heard from the Fed during the week, no change in rates there, and probably an acknowledgement actually for the first time from the Federal Reserve that we were seeing the impact of, or the lagged impact of the previous rate rises feeding through into financial conditions. So in rounding that all out, we're probably closer to the peak or at peak.
Yes.
And that's probably a good thing.
That's a positive thing
because
for investors. Yeah.
The thing that's been driving the volatility in bond markets has been interest rates moving at a clip of 50 basis points per meeting, or in the case of the US, 75 basis points per meeting. So that, which has been causing the volatility, i.e. rate moves, hopefully we're at a point where we can say there's less need for further interest rate increases, all else being equal on the inflation front, but likely that those rates stay at a higher level for a longer period of time.
And it's kind of, this ties into a little bit of, we talk around 20 years of markets and how you manage market volatility over that period of time, and Chris, you mentioned two big events, but from an investor's perspective, Luke, when I give advice to a client, it's always, this is a minimum of 5 years investment and on a long-term basis. And I think it's, if we could just tackle this question from 2 points of view, because some things I get asked quite often is that, someone my age, a long-term investment, I'm trying to accumulate wealth for retirement, but there might be people closer to retirement that they may be, they've had the volatility over the last few years, seen a decrease. How do they look at that as well? So there's two questions, I suppose, in one there.
Yeah, I suppose it all depends on your investment time frame. And we always say time in the market, not trying to time the market. But if someone's in accumulation stage, maybe they're in their 30s, 40s, and they're working towards retirement at 65, they obviously have a longer investment time frame where they could maybe take more risk and go to a more aggressive portfolio. But a lot of our clients, and the majority of pension clients who have pensions with us, they may be retiring, say, at age 65. If we look at the average life expectancy in the UK for a male is 85, 87 for a female, that's still a 20-year investment time frame in which their pension can remain invested. That's not to say maybe they could take less risk. You could maybe revise you could maybe go into a more cautious portfolio. But it's really important to remember that just because you're going into decumulation stage, you can still afford to maybe take some risk with your pension. And your pension asset, your other assets, it could be used for legacy planning as well. Start to think about gifts for children, grandchildren, etc. Your advisor can sit you down and work out how much of your pension you might need, how much could be left for legacy planning. But if you start to think about, this being passed on to children, grandchildren, you've got a 50, 60, 70-year investment time frame, a window that shows you've got time on your side. All this volatility we've had over the last 2 years, ultimately, if you have time in the market, it's time for those assets to recover. So it's really important to sit with your advisor, note those goals down, look at how much you want to leave, how much you want to spend. You can discuss risk, but ultimately, a longer investment time frame means you've got time on your side to make the assets grow.
The thing that sort of also feeds into that is that we talk a lot about the need to invest for the long term. And it sounds like a very simple concept, isn't it? But it's actually exceptionally difficult because psychologically, we're all driven by the want to make change, to take action. But it's also focusing on that long term and not taking action is the difficult aspect of it. And I think that's the thing that we all need to think about, that behaviourally we want to take action, we feel better by taking action, but maybe you don't need to take action. You leave things be, let them move. And I think that's something that's probably exacerbated a little bit by what you see in the media. It's about short-termism, whereas what we're trying to engender is a view and an understanding that time in the market is the much better concept, which is long term, but it's difficult. It sounds exceptionally easy, but it's a very difficult thing to get across.
We talked around this earlier on today, but if you look back at the financial crisis, very different world then in terms of, from an investor perspective. you didn't have the social media, you didn't have the access to the information. It was on a more regular basis, so you had a slightly different concept. Where now, where we're seeing that volatility, you can see a lot more, and there's different things from social media perspective that come through. So it is just around just understand that it is a long term investment, a long term thinking, and that's quite important from my perspective, because you made a good point there in terms of interest rates flattening. And if there were, there was always going to be a top, and at some point, and that's when you start to think that things might actually get better. We always knew that was going to happen. It's just, when is it going to happen? It's just sitting in your seat a little bit to control that.
It's also important to think about that in the concept of within multi-asset portfolios, that it might not be that things are getting better. It might be that the way assets in the portfolios they work differently. And really, if we think about back to where we started the conversation, the challenge there was that we had both fixed income assets and equity assets being correlated together. So if they were going up, they were going up together. If they were going down, they were going down together. And that's all tied to the inflation and the interest rate environment. If we're thinking into the future where that might be different, if interest rates are being reduced, it might be because the economies are slowing, and that should be positive for the fixed income elements of portfolios. It might cause challenges elsewhere, but that's certainly something that, with the way interest rates have moved and the way sovereign bonds have moved, you're now getting compensation for being exposed to those assets.
So Jeff, in terms of, a question I get asked quite often from clients is, should I just sit this out for a period of time and wait till the bumpiness goes off and then get back invested? And I always kind of say, well, if you know when the bumpiness is going to end, that might not sound a bad plan, but we don't know when that's going to end. What would you, both of you, what would you think of that sort of situation?
I think for me, it's very much about thinking about what is it that would give me an informational advantage to say, I can say that is the right thing to do today versus yesterday, knowing that the market is kind of up or down roughly 50% of the time. It's either up 50% or down 50% of the time. That's a very difficult call to make. It's a coin flip. So why would one try to do that? Why would one not structure a set of assets that through time, focusing on that longer term, allows you to achieve the goals that looks discussing? So yes, you can think about broader signals in the market that might say, at an asset class level, I want to own more equities or I want to own bonds. But to be all in or all out is a very difficult decision to make. And I think the more difficult and more challenging aspect of that, going back to that long-termism point, it's very easy to say, I'm coming out. Because it's all in the headlines, it's all very negative. But nobody's going to ring a bell and say, well done for coming out, how do I get back in to the market? And I think that's why it's much more about staying invested and using those opportunities just to incrementally potentially just add through a direct debit. If you're just buying on a monthly basis or a quarterly basis, over time, buying higher, buying lower, it works for you.
It's interesting. So I've got a slide here. So just on the kind of first slide I was going to show, which is basically looking at, it's a chart of that same 60-40 index that I was talking about. And it goes all the way back to 1999. And it shows what happens if you, it's on the screen now, what happens if you stay invested, which is the top line, the purple line. And then it shows what happens if you take out the 10 best days. Now, to give you the figures behind that, the starting point is £200,000. So if you stay invested, it reaches 800,000. But if you take out the 10 best days, bear in mind, think how many days there are from 1999 all the way up to now. Take out just the 10 best days, that 200,000 goes to less than 600,000. So for me, that really shows the importance of staying invested.
Not being able to judge. I think this is the thing. You do, as Jeff says, you don't know when the ups and downs are going to be. Another one that Luke and I get quite often, I'll direct this towards you, Chris, is obviously the increase in interest rates has affected cash, and you can see in many, I'll just say a couple of things around this in terms of percentage cash that you can get interest rates in the bank. And what I would say is there's different types of products, and you should consider that, because just because you're getting offered a rate within the bank of 4 or 5%, if it's in a bank account, there is tax implications that you need to understand on that. But we'll come back to that point. What's the views on that? And actually, out of interest, I'm gathering we have cash in the portfolios.
Yeah, absolutely. So I think maybe to answer your last point first. Yeah. So we do have cash in the portfolios. It's held really 3 ways. So the first way is we have cash with our custodian, which is a bit like holding cash in a bank account. Yeah. That tends to be quite small, and that's for daily trading, etc. We then hold cash with money market funds. And we also hold cash in short-dated bonds as well, so less than 1 year. So for us, cash is a tool where we're receiving a significantly higher yield on it compared to, say, 2 years ago, in the same way that someone looking at a national savings account or something like that will receive more than what they would receive 2 years ago. Now, we were actually discussing this, weren't we, a couple of days ago. This may come as a bit of a surprise, but we've actually taken cash down within the portfolios. So if you look year to date at the balanced portfolio, we've taken around about 0.5% out of cash. And the rationale behind that is really building on what Jeff was saying. And that's because we've seen opportunity elsewhere. We've seen opportunity in fixed income, and we've seen opportunity in equity. Therefore, we're happy to spend some of that cash. But maybe just thinking around, cash and kind of forward-looking returns. And I've got another slide on this, very exciting. So what we've got here is my final slide, which is, there we go, that's the one. And what this shows is basically forward-looking returns. So these are expected returns that are independently formulated away from us. So they're formulated by Morningstar. And what this looks at is potential expected returns on average for the next 20 years. So the bar on the left, global equities, the one in the middle, global bonds, and the one on the right is cash. And so there's 2 points really. I think the first point is you can see that after the volatility we've recently experienced, expected returns are higher. You'd expect that. I think the second point, and hopefully this is very, very clear from the slide, is you can actually see that expected returns on cash are the lowest out of all of those asset classes. And the reason for that is, as a long-term investor, if you want to hit your goals, then you need to be invested in risk assets.
Yeah, totally agree. I think just to finish on the point that I mentioned around the tax implications.
Yeah. Sure, so interest on cash, if it's a savings rate, you might get 4 or 5%, which sounds attractive, especially at the minute of volatility. But in a savings account, there's no tax benefits. In an ISA or a pension where you have tax-free growth. So it's always urge caution if you're going to look to remove from an ISA or a pension to go into these products. The interest is taxed as income. So if you are earning income, if you're a basic rate taxpayer, you have a £1,000 limit where you can earn interest. After that, you'll pay basic rate tax. That limit's reduced for higher and additional rate taxpayers. So if you're a higher and additional rate taxpayer, you'll lose nearly half of all the interest, which is taking that down to maybe 2-3%. It's always something to consider. With pensions and ISAs, you're not likely to get that higher rate on cash that we're seeing on the high street.
Great, thanks, Luke. And Jeff, we'll let you finish off on here. I think I'm not asking you for a prediction, so I think it's please don't think I am. But actually, we're nearly at the end of the year. I can't believe it's getting dark outside, which definitely tells you you're getting near the end of the year. Where do we see markets over the next sort of few months in terms of what are the not so much challenges? What's the things that we should be looking out for?
Maybe one way to frame it is what can we say about what we have seen and what we expect to continue to see. And I think the first one of those is that time of disinflation that we've been in over the recent period. So we've seen inflation continue to come down. I think we can say that we expect that trend to be sustained, and that probably feeds into interest rates being at or close to their peak. So that's two things that I think we can probably say is going to continue. Hopefully that means that volatility in sovereign bonds as well starts to come down a little bit, and certainly that would be very beneficial for the bond market in and of itself, but also for equity markets as well. So taking that together, there's a number of factors that have been displaying and bringing about the volatility in asset classes that we may be able to start to say are starting to look close to or being behind us. That in and of itself would offer a much better starting point for us. I think the other thing to say is, it builds on something Chris was saying, that within the portfolios, our managers themselves, they are seeing more opportunity within sovereign bonds today than they have done for a very long time. And that just comes back to that fact that those yields today are much more attractive than they have been in any period in maybe the last 20 years. So there is that element of portfolios as well. And then just that role of different assets at different points in time within the portfolios.
So some reasons for optimism.
Yeah.
Great. Thank you, Jeff. Gentlemen, thank you very much.
Thank you very much.
Good session then. I think hopefully we've answered some key questions that have come from clients. So I really appreciate your time. And thank you so much for listening and listening to what the gentlemen have had to say today. Please do feel free to contact us if you do have any further information, or subscribe and like the podcast video. So thank you very much. Hope you have a good day. Thank you.